The current live price for Netflix Inc. NASDAQ NFLX is $1,112.17, which marks an intraday drop of $42.06 or 3.64% as of the last available quote. Now, a decline of over 3.5% on a high-flying tech name like Netflix stock is naturally going to make investors pause, and the surface-level expectation is that this is simply post-earnings profit-taking combined with a broader market tremor, the narrative being that the stock ran too hot after its latest report. However, the unexpected insight, the angle that many are missing right now, is that a substantial portion of this pressure isn't just about valuation worries, but is a preemptive institutional positioning move related to the upcoming 10-for-1 stock split. The split, scheduled to take effect in just a few days, is creating a temporary, somewhat artificial demand and supply imbalance as large institutional players who are comfortable holding shares near the four-digit price adjust their books or engage in arbitrage plays before the lower price point potentially attracts a massive influx of retail flow and options trading, which can often inject unwanted volatility into institutional models. This is a crucial distinction. It's not a fundamental deterioration. It's a technical adjustment to a corporate action designed to broaden accessibility. The general belief about Netflix stock over the past year has been one of a stunning comeback story, a narrative shift from the streaming war loser to the profitability king. Investors celebrated the success of the password-sharing crackdown and the rapid scaling of the ad-supported tier, which collectively validated the company's pricing power and its ability to find new ways to extract value from its massive user base. This led to a significant upward move in the stock, well outpacing the S&P 500's return and solidifying its position alongside other titans of the market, which is why seeing a 3% drop feels jarring to that established expectation. But the contrarian, deeper take we need to consider is whether the current price, even after this dip, has fully priced in the future growth of that nascent advertising business. The immediate stock movement over the last few trading days highlights this tension perfectly. Following the latest quarterly earnings report, where the company missed on EPS largely due to a one-time Brazilian tax charge of over $600 million, the stock did not collapse as many would have expected from a high-multiple growth stock. In fact, it initially edged higher in after-hours trading. This resilience in the face of an earnings miss is a strong signal of institutional conviction in the underlying operational story. They looked past the temporary accounting hit and focused intently on the strength of the revenue growth, which accelerated yet again, and the management's commentary on the ad-supported tier. That ad business, while still a relatively small component of the overall revenue stream, is scaling fast, with management guiding for it to more than double this year. The market understands that a rapidly growing, high-margin ad business on a platform with over 300 million paid memberships globally is a massive long-term value driver, fundamentally changing the company's margin profile away from the pure content cost-heavy subscription model of the past. The institutional trading action shows money managers are willing to hold through the noise because the core thesis that Netflix has successfully pivoted to a multi-revenue stream powerhouse remains intact. Furthermore, the volatility in volume, particularly in the lead-up to the split announcement, indicates a battle between short-term traders looking to scalp gains after the strong run and long-term holders, many of whom hold through vehicles like Fidelity mutual funds or various Fidelity ETFs, who are focused on the projected operating margin expansion. Looking closer at the fundamentals, the Q3 report was a case study in managing expectations versus delivering operational excellence. The revenue of $11.51 billion met forecasts, and year-over-year growth was robust at over 17%, marking the 8th consecutive quarter of double-digit top-line expansion and a clear acceleration across the year. The operating margin narrative is also compelling. While the reported Q3 operating margin contracted year-over-year due to that one-time Brazilian tax charge of over $600 million, management was clear that without that one-time cost, they would have exceeded their margin forecast. They still expect a full-year 2025 operating margin of about 29%, a healthy step up from the previous year's 27%. This systematic, planned expansion of margins through better content efficiency, pricing power, and the scaling of the ad tier is the real backbone of the stock's performance, not just a fleeting hit show. For those who invest online, whether they use self-investing platforms like Robinhood stock trading or the more feature-rich Interactive Brokers trading platform, this shift in margin profile is the most tangible evidence that the business model is maturing into a highly profitable media giant. The days of Netflix needing endless subscriber additions in mature markets for the stock to work are gone. Now it's about increasing average revenue per membership and scaling profitability, which is a much more stable, less volatile driver of long-term stock value. The core business model of Netflix Inc. is a hybrid subscription and advertising content delivery powerhouse. It transitioned from a DVD-by-mail service, founded in 1997, to the global streaming leader it is today, offering a vast library of original and licensed films and series to over 300 million paid memberships in more than 190 countries. The primary revenue stream remains subscription fees, which are diversified across multiple price tiers, from ad-supported to premium ad-free. The recent addition of the ad-supported tier, which accounts for a significant portion of new signups in mature markets, and the crackdown on password sharing are the two major tactical successes that have reignited revenue growth and, crucially, validated their ability to monetize their massive reach. This move demonstrates a sophistication that rivals other major individual brokerage platforms that have expanded their offerings. Just as Fidelity or Schwab Intelligent Portfolios adapted to the demand for accessible investment help, Netflix adapted to the demand for a more affordable, yet still profitable, streaming option. The company's massive investment in content, which can be a double-edged sword, has now led to powerful intellectual property that can be extensible into gaming and merchandising, offering further long-term revenue diversification. The competition remains fierce, with rivals like Disney, Warner Bros. Discovery, and Apple stock constantly vying for market share. But Netflix's sheer global scale, its data-driven content recommendation engine, and its early lead in a mature, consolidated market give it a defensible position that analysts widely respect, with a strong consensus of buy ratings and average price targets well above the current level. The future outlook for Netflix is intrinsically linked to the continued success of its ancillary revenue streams and its disciplined approach to content spending. The biggest near-term catalyst is the successful execution of the stock split on a technical level. While it changes nothing about the company's valuation, the move is psychologically important. It makes the stock price more palatable to smaller retail traders, which could boost liquidity and trading activity, particularly on platforms like Robinhood app, which popularized fractional shares. For the institutional investor, it might simply mean more shares to trade, but the potential for higher retail interest is a factor. Beyond the split, the key opportunities are expanding the ad-supported tier's average revenue per user, ARPU, through better targeting and inventory management, and effectively monetizing the new ventures into gaming and live content, such as their foray into boxing or other sports. The main risks are macro. A global economic slowdown could push more subscribers to cancel or downgrade to the cheaper ad-supported tier, potentially impacting overall subscription ARPU, and the ever-present threat of content cost inflation as they compete for top-tier creators. However, the expectation now is no longer of subscriber stagnation, but of margin expansion and effective global monetization. The reality is that Netflix has shifted its focus from simply growing the top line to optimizing the bottom line, a much more sustainable model for a company of its scale. This transition from a pure growth, high burn model to a profitable, cash flow rich machine is what justifies the premium valuation, and it's a strategy that requires investors, whether they prefer online investing through intelligent portfolio services or through the Fidelity mobile app, to look well beyond the daily stock swings. The path to continued stock appreciation relies not just on getting more users, but on getting more from the users they already have, and all recent evidence points to them executing that plan very well. The most intriguing aspect of the current movement is the high-stakes dance between the algorithmic short-term traders reacting to the 3.64% dip and the long-term institutional buyers quietly accumulating shares based on the margin expansion story. This creates a moment of high tension in the stock. Comment below how much you think the ad-supported tier will contribute to Netflix's total revenue by the end of 2026, expressed as a percentage, and let's compare our long-term projections. In closing, the story of Netflix Inc. is currently defined by the contrast between investor expectation and the operational reality. The general market expectation, fueled by the daily tape, sees a highly valued stock dipping after a mixed earnings report, suggesting a pause in its powerful multi-year rally. The reality is a company in the middle of a strategic and structural transformation, successfully pivoting to a multiple revenue stream model that prioritizes robust operating margin expansion over just subscriber count. The recent price movement, including the 3.64% intraday dip, is best understood as technical noise, a combination of short-term profit-taking and technical adjustments preceding a major stock split event designed to improve market accessibility.